So, hi everyone. I'm here with Jason Wassell. So, Jason, you're the CEO of the Consumer Credit Trade Association, and so you work with lenders, groups of lenders, really across in the UK, dealing with issues, and you're really their trade body. So, thanks very much for joining me. Really appreciate it.
That's no problem. Yeah, absolutely. We've been around for 130 years, so we've got a bit of history behind us. And as you know, we tend to represent what we call alternative lending, and that's a mix of alternative products or alternative customers. In terms of products, that might be products that people are not so aware of. Some of those might be things like pawnbroking. It might be high cost, short term. It might be different forms of car finance, but those kind of products are maybe not as familiar to how people are not as familiar with. And then in terms of customers, often we serve customers that are badly served or not served at all by the mainstream, and that's where we fit in, trying to kind of provide access to credit to those individuals and those families.
I mean, I always quite enjoy chatting with you because a lot of your customers are sort of in that alternative space, and often the more unusual cases than say some of the larger mainstream kind of lenders. And so you sort of see some of the challenges, particularly with things like legislation coming up, even arrears levels, those kind of things. And so it provides quite a sharp focus around what are some of the issues that are kind of out there. I mean, what are some of the challenges that when you've been chatting with members that I suppose that they're seeing or they're feeding back to you in terms of like hot topics and issues?
Yeah, I mean, I think you're right. I think the only reason we exist is because 130 years ago, the banks were not providing credit in the way that made sense to many kind of UK families, and there was a need for something else, and that's why we stepped in. There's an even deeper story about how we were created around sewing machines and how the big family purchase of those times was not the big screen TV, obviously, or the new car. It was the sewing machine, and banks didn't lend to families, particularly poorer families, to buy sewing machines, and that's where we stepped in. And 100 years later, we continue to have a very different view to the banks on a number of things, but that means we can identify problems or difficulties for smaller lenders. And what they're seeing just now is that the pressure is layered at the moment. There's not one big problem or one big issue. It's not one reform. It's not one big change or reform. It's not one policy change. It's a layering effect. Because over the last few years, we've moved away from some of the sharp economic shocks, the energy crisis, the pandemic, supply chain crisis, things like Ukraine and the focus on that. But we are still in a prolonged kind of squeeze on families. Affordability pressure hasn't disappeared. It's there every day. And that makes it more difficult to lend because those decisions are more difficult. And for some mainstream lenders, that's enough for them to pull back. For many of our members, that's why they exist, is to kind of step in.
I mean, one of the things you talked about there was looking back historically around sort of historical performance and those kind of things. And obviously, we've got motor finance redress scheme that's sort of out there as well. And that's one of the things that was. I mean, we're waiting for the final scheme, I think, aren't we? But that could go back further than the 6 years, I think. I mean, they were looking further back. I mean, what's your view, I suppose, on how you think that's going to come out, what the scheme's going to come out as, but then also, I suppose, how much of an exposure is it and a precedent is it about going back even further, right? I mean, because they're digging out records. I mean, so I know some firms are struggling to dig out records. I mean, because it was way back.
Yeah, I think once again, I mean, none of this is simple, is it? All of it is complex. I think once we saw that the regulators and the court's position, once that was clear, now we can disagree with some of the decisions that were taken, but those decisions are there now. And the only sustainable solution is a structured redress scheme, a statutory redress scheme. I think it's sometimes called a redress scheme is the only way forward. And we were slightly different. And I think we probably, as a trade association, were influenced by the experience of mass redress in other sectors. And we've got members that were in high cost, and therefore were involved in some of the high cost claims in days gone by, guarantor lending, home collected. We were involved in some of those discussions. So for us, we came out of it with a different set of experiences. So we actually were very keen to go as far back as we could, recognizing that if we left any gaps, those gaps would be filled by legal firms and claims management companies that would spot the gap and go for those gaps. And so we were very much kind of wanting to avoid that fragmented complaint by complaint resolution, which would have created confusion and created uncertainty for the customer and would have caused real kind of operational problems for our members as well. So we were in a slightly different place to other organizations that were kind of talking about much shorter. I mean, but that makes it complicated, as you said. I mean, there are people that quite rightly remove data from way back, from going back to 2000, 2008. GDPR pushes us towards considering the information that we keep, destroying the information that we no longer require. And it seemed as if, quite rightly, there were decisions made about destroying that information, removing that information. It didn't look like that was going to be required. We seem to be abided by GDPR, but it has put companies in a difficult position because now it's very difficult to reconstruct that data or to find that data from elsewhere.
I mean, it seems like it's a precedent for us. I'm still thinking about what we need to do today is making sure that we're recording things, and it puts that pressure back on the data, doesn't it? Making sure you're really sort of documenting things, making sure you've got agreements documented, you can access them, those kind of things, which with sort of like 2026 eyes, we kind of know it was, but going back to, 20 years ago, or even it was kind of like we're in different kind of world then. I mean,
well,
we know that, right?
Even just go back a couple of years. And as I said, that the focus from an information and the information focus, the privacy focus, the kind of implementation of GDPR, which has now been with us a few years, but go back even a couple of years, and we would talk about data minimization. We would talk about protecting people's privacy by destroying data if it's not required. So even a couple of years ago, we would have quite rightly thought that this was the appropriate way to go. 2026 with a claims culture, with a mass redress culture, where now, if I was in another sector, I would be thinking about what have I got to keep, what do I need to do to protect myself for something in the next 5 years.
I'm still way back with loan agreements written by hand and sort of being shipped off to Iron Mountain and going through lots of paper and all those sorts of things. I mean, it was a different world, wasn't it, back then? So I suppose it's around infrastructure, right? And the learning for us is around infrastructure today, and making sure we're trying to future-proof that as much as we can, I suppose.
Yeah, but it's the wrong thing to be. I think it shows there's something wrong when we are keeping data, because there is a risk that in a decade's time, somebody will come back and say, you didn't implement consumer duty properly. 10 years down the track, the FCA comes back and said, that decision you made and about consumer duty and how you thought consumer duty was implemented, we think that you got that wrong. Well, let's go back 10 years and let's have a look at that and let's start doing redress. And that's what lenders have to think about right now, is like, what could happen in 10 years' time, which is wrong. There's something fundamentally wrong with the way in which we are regulated. And I think it's something that we've been pushing hard, is that we need to change. If we are changing our culture, we need a change in the culture of regulators as well. We can't have the situation where something starts to seem to go wrong, or there's indications that something might be going wrong, and then the FCA takes 6 months to consider that, maybe draws up a report that takes another 3 months, maybe brings that back to people, and maybe there's some kind of informal consultation, or maybe a formal consultation. We're now a year down the track, and something that could have been dealt with at the very beginning is now, if there was a problem, we've now had a year of that particular problem and of things going wrong. We need a new way of regulating, where regulators and the financial ombudsman are talking to lenders quicker, and that we have a discussion about these issues sooner, rather than waiting for a year, realizing we've got a problem, another year to get a redress in place. And suddenly we're always looking back over the last couple of years and thinking that something might come down the track and hit us.
I mean, to your point, it's almost like, it sounds like how do you provide that certainty for business as much as possible going forward, and sort of minimizing any period of uncertainty as small as possible, so businesses can plan and they can plan ahead and those kind of
Exactly.
things. Yeah. I mean,
Exactly. The longer we have uncertainty, the more likely we're going to have problems, the more likely that's going to be more expensive for us and more difficult for the customer.
you talked there just, you mentioned claims management companies, and obviously we've got FOS reforms that are coming in, sort of like in I think it's in Q1, so around about now anyway. So what's I know that's been a pressure for some of your members. What are your kind of views on particularly the FOS reforms with the fee changes and those kind of things? I mean, how's that going to change those dynamics?
I'm going to surprise people that have listened to me at conferences by saying that some of what we are seeing from the financial ombudsman is really positive and really progressive, and we would welcome many of those changes. We in particular welcome the change that was made where CMCs were asked to pay towards case fees. We thought that it was a blatant unfairness that lenders were paying for the operation of FOS for the case fee, win or lose. That was fundamentally unfair. And what it also did was it pushed the model towards quantity over quality. If you are creating a business model around claims, then you recognize that system distorted it and said to you, it has to be about quantity. It doesn't matter about the quality. Just put as many of these in as possible because there's no cost to you, and some of these will pay out. And it became a harvesting exercise. Just go out on social media, gather in as much as you can. Don't do as little work as possible because that's not in your interests from a financial perspective, and just get it in to the firm. Let the firm do all the work in analyzing the complaint and then pass it on to FOS. And that was fundamentally flawed. So that was a great change. They haven't gone far enough. Many of our members would say that CMC should be paying what a firm is paying. That's what we should be. That's where we should get to on this. There shouldn't be some kind of a discount if you're a CMC or a professional representative. So there's one thing. There are other things that we've seen where they're getting better, looking at files as they come in, new portals, some real positives there that we kind of welcome, but more that could be done. Absolutely more that could be done.
I mean, these are always things, and sort of chatting with you seems to be like the law of unintended consequences sometimes with these things. And so you just talked about that on the initial piece. I mean, I think they're having a different fee in terms of like how far it gets along through the claims management process and those kind of things. I mean, do you think are there any sort of unintended consequences we could get as a result of that? Do you think, like, earlier settlements coming through, maybe ones that should have gone through the full process and didn't, those kind of things?
We are worried. We're worried about. I think we saw this where we brought the idea was developed, the process was developed, which is have a look at these again, try and deal with them before they go to FOS. That kind of like FOS coming back and saying, have another look at this. But there was, but still you'd be paying a case fee on this. And that, I think sometimes the FOS just doesn't understand the mechanics and how these models work. And that's fair enough. It's for us to explain that to them. But we do kind of think that there are the potential for unintended consequences. We look through every proposal to try and work that out, but we've got to be open to the fact that we may miss something. So yes, absolutely, there is the absolute risk of unintended consequences.
But it sounds like you're pretty positive, or your members are positive. I mean, it's a step forward from where it was before, which is, I mean, that sounds like that's a good thing.
Yeah. There's more to be done, and I think I talked about earlier about talking earlier about problems and issues that they see, and we were very keen, and we were pushing. In this regard, we were pushing with UK Finance as well, the idea that we should have some kind of wider implications discussion earlier in the process, that there is a wider implications framework that brings together members of the regulatory family to talk about things that they see that might have wider implications, complaints that FOS sees or FCA sees that might have wider implications. And our view, and UK Finance's view, was that that was a great opportunity to get industry and the consumer, get industry and the consumer involved at that stage to try and identify wider implications earlier, have that discussion, rather than waiting, something going wrong, and then waiting, and then a decision being taken.
Yeah, it'll be interesting when we watch that space. I mean, the other one we're watching, I suppose, is buy now, pay later that's coming through. I mean, there's a long list of all these things that are happening. So it just feels like it just doesn't stop, which goes back to the right at the top, right, in terms of the amount of stuff that's going on. I mean, that framework, I think it's due to come in July. I mean, how do you think firms need to prepare for that? What are you sort of like? What are your thoughts around that sort of coming in, and what will that do in terms of like the lending sector as well? Because it's been sort of considered a bit of a shadow lending sector versus the regulated kind of sector, and now that comes into the regulated piece, and sort of how do you think that's going to shift things around?
I mean, quite clearly our interests amongst a range of lenders. Some of those lenders will have a buy now pay later product, and some of them will use what might be considered a more traditional retail finance product where interest is applied. So we're coming out with a couple of different kind of dynamics in play. There's a couple of different voices in our ears at the same time. But I think what we think is fair is that there should be regulation of buy now, pay later, that it's understandable that it is the right thing to do. And I guess we land in the area of a level playing field, that we think there should be a level playing field, that there needs to be consistency of regulation across credit products. There has to be transparency about risks and benefits for customers, and there has to be clear accountability and positive objectives. And when you look at all of that, they all map back to the FCA regulation in terms of accountability, SMCR, in terms of risks and benefits. That's been clear about providing credit information, consistency of regulation across products. Looking at how this is considered by things like the Financial Ombudsman as well. So the principles map to the FCA regulation, and therefore we think that this is the way to go. Our concern is always going to be about implementation, and that matters enormously as we now start to see final rules, as we've got deadlines now come in place. We've got to kind of work towards that. And, for buy now, pay later lenders that have not been involved with the FCA, there's a bundle of things that they now need to do. But I know that some of them have already been thinking about this, clarifying responsibility along the chain, strengthening affordability approaches, building complaints processes and how that works with FOS. They've got to embed consumer duty, of course. And they're going to have to upgrade their data and record keeping in some ways because of some of the things that we talked about earlier. So the operational task for them is not trivial, and I kind of don't underestimate that at all. And there's also a cultural thing there, which is that they're going to have to recognize that they're part of the consumer credit world. And I know that can be difficult when there's a pull there that kind of pulls them towards being part of the retail world as well. They've got to have both of those in their view.
I mean, it's definitely going to be an interesting one to watch, as that sort of rolls out. I mean, it's been long talked about, I suppose, for a while, and just seeing how that sort of rolls out. I mean, I suppose the last thing that's been long talked about is the Consumer Credit Act. I mean, that we've been talking about that for many years now in terms of some reform of the Act. I mean, do you think we're going to get it in this Parliament? I know there are views around maybe we're not going to get it in this Parliament with everything that's kind of going on. I mean, and again, that's a massive change potentially because it's at least what we've got now, we sort of know and it's stable. And we don't know what we're going to get, right? So it's kind of like, where do you think we sit on that?
I think you can imagine that we speak to the Financial Conduct Authority on this. And this is mainly sat with the Treasury up until now. We have regular conversations with the Treasury teams about this, and we've been involved in a number of discussions and roundtables. So we're aware that it's probably not moving as fast as people expected or hoped for. So I think we are seeing a delay. I think there is still a wish to move forward with this. I think there is still that hope that we can make change. I just think it's going to be slower than people expect. I think the timeline has kind of not grinded to a halt, but that timeline is going to be longer than many people hoped for. And I think for us, we welcome more time to think about this and welcome more time to discuss this, because as you said, and as I've explained earlier, we're not one of the trade associations that jumps up and down and says we need to regulate and reform the Consumer Credit Act, because our members, our smaller members in particular, like the certainty that comes from the Consumer Credit Act. Knowing when to do things, what to do, and how that's done is really useful for them. So they say that, but at the same time, there's also recognition that many of the aspects of the Act were built in the 1960s and 1970s. The world has moved on. So we do see the need for change. But in that change, we would like to continue to have guardrails that help us, guidance that help us, so that we're not just removing the Consumer Credit Act and saying, you get on with it, we leave it to you, because that is a recipe for people coming back in 5 years' time saying you've misinterpreted this part of the new Consumer Credit Act, or how the Consumer Credit Act is transferred over into the handbook.
And I suppose, just to your point, it's also around managing change. I mean, everything we talked about is current change. This is potential future change. And like, how much do you want it to change while you're dealing with everything else happening at the same time, and making sure you're understanding what the impacts are? I mean, there are some things that are frustrating, like letters and those kind of things, but let's do it in a controlled kind of way, it feels like.
Definitely. And once again, it's about resource. We don't have the resources to start again with communication materials and to test it with focus groups, and then do A/B testing, and then bring in consultants to help us craft it and to recraft it, another consultancy to review that and to review the response of customers. We don't have those resources. So wherever we can have best practice, wherever that work can be done collectively, we would absolutely welcome that. And that's what we want. We want, as we move forward, as we improve the position, the situation, the communication, we need to do that in a way that kind of shares best practice, is collective in its approach, and doesn't leave us all to make around our own decisions and potentially get it wrong.
And I suppose, lastly, if you look out in the next sort of like 2-3 years, what are some of the things that you think we got to have on our radar, or the firms have to have on our radar? I mean, what are the things that are top of mind?
I think we have an agenda here that is not going to go away for a reasonable amount of time. I think that already today we've talked about motor finance implementation, BNPL regulation. We've talked about Consumer Credit Act reform. I've talked about the need for a culture change, the regulatory in the regulatory structure. That be the financial ombudsman, that be the financial conduct authority. So I think there's an agenda here that is going to go on, not just for 2026, but go into 2027, go into 2028. I think for us, we will consistently come back to those central issues which I started with, around burden and certainty. Firms want to operate at the highest standards, at the best standards possible. They want to provide good service to customers. But what we struggle with is where the goalposts move, where there is retrospective link risks that we talked about earlier, and where there are layered obligations that come in without simplification, just more and more things added to our agenda. So our strategy is explicit. We've got to tackle the burden. We've got to promote regulatory certainty. And we do that with that strong agenda that we've got right now, that heavy agenda that we've got right now, and we will look out for what's coming down the track. And you can't have a conversation anywhere where we don't talk about the growth of things like artificial intelligence. Would that be It's certainly a conversation we're having internally now amongst some of the smaller lenders. Is that something that would help close the gap between larger lenders and smaller lenders when it comes to the way in which AI could help with operational matters, but could it also help with compliance matters as well? I've talked about the fact that we may not have the ability to build it, to bring in external advisors at huge cost, particularly where there's a premium attached to it. But could AI help in building that knowledge and the ability to help with compliance and to understand what the FCA regulation means for individual companies? Could it help there? So there are things there that we're interested in, but then how is that regulated becomes the next question to ask.
Yeah. I mean, there's no shortage of things going on. It's always fascinating chatting to you. So, I really appreciate it. But I say it's plenty to do and plenty to watch. So, Jason, thanks very much. I appreciate you making the time. I really do. I always enjoy our chats. So.
Thank you. I mean, we always have our discussions at on the fringe of other events. So great to sit down and have a conversation. We're always, I mean, the only reason we exist is to talk on behalf of our members. We're always happy to talk and to be involved in discussion. It's what we're paid to do. So happy to take part.
Yeah, fabulous. Well, thanks very much.